Let's get more on today's post-Fed sell-off with Ben Emons of FedWatch Advisors. Ben, great to have you with us. I quickly read through your note. You're quick on the draw in terms of getting this note out. But bottom line, you think yields are headed higher. Full retracement to 475. How high do you see it going in this environment, in this new environment now?
Yeah, Mel, as Powell said, right, we're kind of shifted environment. He admitted that himself. And you know, it was interesting to see that forecast come out because by showing a high inflation forecast and showing, particularly in the back end, the members of the FOMC seeing upside surprise to the inflation outlook, I think that's what triggered the sell-off today in the market, particularly in rates, and that spilled over into the broader market. And yes, you're breaking 4.5 here, as we talked previously. So 475 is the high of this year. So that's an easy retracement. But to an earlier show from April, I believe, it's 5.3, right? It means that's really the upside there. And if I calculated that Taylor rule really quickly on the forecast from the Fed today, that's actually what the Fed funds rate should be today, 5.3. We're about 80 basis points easier. So there's a lot of opportunity here for yields to go higher, I think, given the Fed's change in tone and change in reaction function today.
So how do you piece that environment for equities together for next year if we are to say that rates could glide higher to above, just above 5% or so? But we are also looking for, the conditions for a stronger dollar, maybe slower earnings growth. I mean, how do you sort of put it together in terms of what the environment is for equities?
I don't think it will necessarily be a deteriorating environment because, strong dollar, better growth, high yields, that still talks about that very, very good economy, as Paul said. And I don't think under that condition, the equities would actually sell off majorly. I think we have to just sort of digest ourselves to an environment where the Fed may not just simply be easing any longer. So that's, I think, today's indigestion. But for the outlook, that I don't think changes anything other than if you're getting inflation really coming back meaningfully. So the Fed wants to get ahead of that inflation by being more focused on inflation in their forecast. So I think it's a good backdrop. I think to Courtney's point, the deregulation is a key element next year, including to the tax cuts, that will continue to drive the sentiment. We just have to get used to a Fed that's going to be likely on hold and show a little bit more like force on inflation. I think that's the only thing that could hold equities back.
Ben and Karen, thanks for being on. Yesterday, there's a big piece, target T. Rowe price of 5 or 6% even 10-year. And one of the things they cited was foreign governments not participating as much. Do you see that happening and adding further pressure to the 10-year?
It's possible, Karen, because that is a good point by T. Rowe. We talk oftentimes like the Fed doesn't have the U.S. doesn't have a deficit problem, has actually a debt maturity problem. And in other words, we're just financing too much with T-bills. We got to move that out the curve. That's still not really priced in. I think that's what keeps maybe these foreigners away a bit from the auctions as T. Rowe analyzes, because if that's the case and we're moving higher with yields, we got to see those high yields first before the foreigners come back. So I would agree with them. I'm not sure if 6% will be the end destination. It's more like above 5%, but that's reflective of an economy, I think, that emerged next year stronger towards more 5% growth. So that's good for equities, but yeah, bond yields should be higher.